Today, we're going to talk about solo brands. They just reported earnings. They own, you might not know the name, the ticker is DTC. They own Solo Stove, Isle, Paddleboarding Company, Oru Kayak, and Chubbies, my favorite clothing brand. If you haven't seen the shirts I wear in most of my YouTube videos, they're pretty much all Chubbies. DTC reps, Chubbies reps, if you're listening, I am open to a sponsorship. All right, those are expensive shirts. I'm also going to talk Disney earnings. The market has, rebounded quite a bit. As great as that feels, it's important to keep our heads about us and not get reckless or start making bad decisions. So just a reminder there. All right, so solo brands, which again, a lot of you may not have heard of. DTC is the ticker. They just reported this morning. Their non-GAAP earnings per share was 40 cents, which beat by 11 cents. That's quite a beat when you look at just the percentage of that beat. It's like, what, a 33% beat on earnings per share. And then revenue of 136 million, which beat by 11 million. And so, I don't know, that was an 8 to 10% beat on analyst expectations for revenue. If this company has staying power, which we talked about some of their brands, and the brands they have, Solo Stove, Isle Paddleboard, Oru Kayak, and Chubbies. As of this report, it's an indication that they do have some strong brands and potentially some staying power. Compared to a lot of other sort of peers, you got solo brands here, you got Yeti here, Crocs, Lululemon, and then I threw Nike in there because it's sort of like the Lulu and Nike are premier brands in my opinion, and these other three are, a lot of people like to compare them to those, but there's a long way for them to go. If you look at Nike's $177 billion market cap, Lululemon's $40 billion, the next largest here is Crocs. So there's a long way before they really deserve to be compared to Lulu and Nike, but I provided them here as comparisons to see, hey, if we're gonna think about taking a risk on a brand like Solo or Yeti or Crocs, we have to compare it to other options that we could invest in sort of the same space. And so that's why I included Lulu and Nike. But if we take a look, we can see on valuation, and so I'm just scrolling down here to the valuation tab, right? And so this is price to earnings, non-GAAP. FY1 means 1 year forward, right? Solo brands, DTC is at 4.7. Yeti's at 18, Crocs is at 7, Lulu's at 33, and Nike's at 30. So that tells me if this brand is for real, if they have staying power, it could be at a significant discount even to sort of the cheapest peer, which is Crocs. But there's more that we have to look into. We have to look at the growth potential, right? And so we could see here they actually have over-earned in terms of earnings per share over the last couple of years because of some of that COVID pull forward. And analysts are expecting, which they could be wrong and they could beat these expectations, but as of right now, they're actually expecting a dip in adjusted earnings, which would make the forward price to earnings actually higher than it is today. So if you look 3 years out from now, or forward 3 years, DTC is trading at a PE of 5 instead of 4.7 now. So that means earnings are going to be lower, expected to be lower. Yeti's at 12.7, Crocs is at 6, Lulu's at 24, and Nike's at 20. So still 4x the PE 3 years out based on current expectations. Nike is trading at 5x, Lulu's trading at. Crocs is about even, and then Yeti is 2 times higher. And so revenue growth forward, and this is where this opportunity could come from if they hit these growth expectations or beat them. Solo's at 70% revenue growth, which is pretty crazy. That's obviously not going to continue forever. Yeti's at 18, Crocs is at 41, Lulu's at 25, and then Nike is down at 8. And so, there's the potential here that Lulu is trading at a major, Solo brands, DTC is trading at a major discount, and it's a major opportunity. But very risky company, unproven track record. You can't even begin to compare the track record with Lululemon or Nike, but there's certainly potentially some opportunity there, which is why I'm looking at it. So if we drop down to gross profit margin, this is where it gets interesting, right? They are DTC is the ticker, direct to consumer brand. where most of their sales come from online, where their brands are going direct to consumer. They own that relationship. If you think about going to a clothing site like Chubby's and you put your email in, they've got your email and or your SMS, your text, and they're constantly sending you offers and discounts and stuff like that. And it seems like they're always offering a discount. So how could they be profitable? Well, if they're going direct to consumer, they cut out a lot of costs of having to sell through third parties or distribution centers. And so they're able to offer sales, A, because it's a high margin product, and so they really don't expect to sell full price anyways. They just do that so they can offer sales. But B, because they're saving on a lot of costs in other areas by their native model. And one of the reasons that Nike has done so well over the past few years is because they have transitioned to more of a direct-to-consumer strategy, which is one reason that DTC is interesting to me, because they're kind of starting there, right? And so Nike has had to sort of like shift its entire model to get more direct-to-consumer, whereas Solo Brands was born direct-to-consumer. And so looking at EBITDA margins, you got DTC at 20%, Yeti at 19%, Crocs at 30%, Lulu at 25%, and Nike at 16%, so they do well there. Net income margin, 5.8% for Solo Brands, Yeti's at 13%, Crocs is at 19%, and Lulu's at 15%, with Nike at 12%. So we would expect, as they scale, for this net income margin to potentially get higher. This is where we've got to be careful. With a younger brand, they're most likely going to have to issue shares either for acquisitions, they might raise debt, they will very likely have a lot higher stock-based compensation, which means that their shares outstanding are going to rise a lot more than a brand like Nike, perhaps, that has now the extra capital, the extra money on the balance sheet, the extra cash flow to repurchase shares. If you bring the share count down, that makes the shares that somebody currently owns more valuable, essentially. There's a lot of other factors, but that's kind of the basics of it. If you issue more shares and there's more shares outstanding, then the current shares that somebody has are less valuable. If somebody's interested in Solo Brands and investing in Solo Brands, they really need to pay attention to is the growth in shares outstanding. And so this is why a brand like DTC is interesting for me to consider, right? If we look at the long-term performance of Lulu, Nike, and even Crocs, 10-year price performance, Crocs is up 358%. Lulu's up 443%, and Nike's up 378%. So if you find a brand in this space that becomes a winner and can keep their market share and can increase profitability and not have to constantly issue shares, there's a lot of potential upside there. The mistake I don't want to make is thinking that every up-and-coming brand is the next Lululemon or Nike. That is certainly not the case. There's a reason that they're two of the brands that stick out, and it's because they have essentially won or are the winners, and there have been countless losers that have grown fast for a couple years and then just diminished into nothing, right? And so we don't want to fall into that trap of just assuming that DTC has the 10-year growth potential that we've seen from Lululemon or Nike. What we could do now is just jump into their earnings release. Here's their report. Net sales of 136 million. So we are talking about, this is in a single quarter, right? So we are talking about a decent amount of revenue here. It's not like they're just at 10 million or 20 million in revenue per quarter. That was up 47.3 million or 53%. Pretty strong growth. Net loss of 19.9 million, which is down 39.6 million. Loss per Class A common stock, basic and diluted, of a 19-cent loss for the second quarter of 2022. Adjusted net income, 17.3 million, which was down 10 million or 36%. Adjusted EBITDA, 23.7 million, which is down 7.4 million. Net sales increased 53%. The increase was driven by activity from acquired businesses and improved demand in both wholesale and direct-to-consumer sales channel. This is what I was talking about. Direct-to-consumer revenues increased 63%. So if we look, their total revenue was up 53%. Direct to consumer increased 63%. Wholesale revenue only grew 13%. Gross profit increased 45.2% to 86.7 million compared to 59.7 million in the second quarter of 2021. Adjusted gross profit increased 46.2% to 88.4 million compared to 60 million in the same period of the prior year, reflecting the impact of purchase accounting adjustments related to acquired businesses. Gross margin decreased 3.5% to 63.7%. So that's what we want to pay attention to. Adjusted gross margin decreased to 65% compared to 68.1% due to increased freight rates and higher logistics costs. Okay, so gross margin is an advantage that this company has over peers, right? We looked at that in the peer comparison. And if we jump back, gross margin 65.6%. Is basically leading. It's better than Yeti, better than Crocs, better than Lulu, better than Nike. We want to keep an eye on that. If they're able to get these freight rates and logistics costs back in line, which I mean, some of that's out of their control, right? We've seen commodity prices and even shipping prices for overseas freight come down. If that continues, then their gross margin will actually probably tick back higher and maybe even be higher than 68%. We'll see. That's a pretty good number for a retailer. But gross margin, definitely something to keep an eye on with solo brands. So selling, general, administrative expenses. This is an area to watch for sure. Increased 69 to 69.2 million compared to 29.7 million. So if you look, SG&A expenses are up more than 100%, which is something we definitely want to keep an eye on because if they're, 50 to 60% revenue growth is great. But if SG&A expenses continue to grow a lot faster than revenue or faster than revenue at all, it's a bad sign in terms of the long-term profitability potential of a business. So just something to watch if somebody's interested in investing in solo. So 17.3 million of the increase was due to activity from acquired businesses. There we go. The remaining increase in SG&A was primarily driven by the following: an $8.2 million increase in employee costs as a result of equity-based compensation. So that's what I'm talking about stock-based compensation and increased headcount. Outlook for the full year 2022 to reflect current visibility into the global macroeconomic environment and consumer trends as follows. Expected to grow in the mid 20% range. So major tick down from this revenue growth that we just saw, right? So 20% revenue growth. Adjusted gross margin is planned to be above 60% of total revenue, and adjusted EBITDA margin is forecast to be in the mid-teens as a percent of total revenue. Let's jump over to Disney, right? We know Disney reported earnings, and I don't even know. So this looks like the stock's up 9% pre-market. Q3 non-GAAP earnings per share of $1.09, beat by 10 cents, so beat by about 10%. Revenue of 21.5 billion, up 26% year over year. See, this is what I'm talking about. I mean, obviously different industries, right? But Disney they've got 21.5 billion in quarterly revenue, up 26%. And so when you see a company with 100 and something million in quarterly revenue forecasted to grow at 20-ish% year over year, now they are coming off pretty strong growth, but still, it just makes me more lean towards sticking with companies that are, proven winners over the long term, than taking risks on a bunch of smaller companies. And on one hand, the upside could potentially be so much more if you nail solo brands from, a $1 billion market cap to a $20 billion market cap. But there's a lot more companies that fail before they ever get there than make it. And so the question is if that's your investing style, and I've made this mistake in the past, do your gains and your ability to actually hold on to stocks like a solo brands that might 20x or something like that, do you have the ability to hold on to those to make up for all the losses that you're going to take? And normally it's like a shots on goal type thing where if that's your investing style, you've got to pick 10 to 20 of them, almost like a venture capital style investing approach to make up for to find that one mega winner, maybe 1-2 mega winners for the 15 to 18, major losers. That's kind of how that math works out. And it's a style. People are successful that way. But there's also something to be said about finding companies like Disney, like Nike, like whatever, that are proven winners really not going anywhere and buying them at what you think are good valuations or fair valuations. Anyways, off track there. They beat on revenue by 490 million. Shares were up 4%. Disney Media and Entertainment came in at 14.1 billion. Parks and Experiences and Products came in at 7.3. And Disney Plus subscribers, I think this is what people are really excited about, of 152 million versus 116 million. So doing pretty good with Disney Plus subscriptions in Q3 2021. Obviously, the stock is up 9% pre-market. What I want to see is just where Disney is at compared to its historical norm, right? And I don't want to look at sales. Let's look at earnings. So according to this, and again, if this data is accurate, then since 2004, Disney's average earnings growth rate per year has been about 9%, and their normalized PE ratio has been 20.7. Right now, it's trading at a blended PE, which FastGraphs does that based on weighted average of the most recent actual value in the closest forecast value. So it takes in recent results and future results, future expectations. It's trading at 30, which is pretty high above its average, right? And if we look, so earnings are expected to rebound quite strong for FY22, 23, and 24, 69% growth, 38 and 16. And the cool thing about FastGraphs is you can take this and you can bring it out. So even if it goes back down to that normalized PE of 20 by September 2024, down from 30 right now, you're still looking at, if they hit their earnings expectations, which they could miss if we enter a major recession or something like that, or they could beat them, who knows, you're looking at a total return of 17% and a total annualized return of 8%, so 8% per year. Now, that's their 20-year history. Let's look a little bit more recent. So now we're looking back to 2011. And what I want to do is I want to take out this just insaneness that happened with COVID that likely brought up this normalized PE ratio. So what we can do is we can just get that out of there. Yeah, this traded higher up to 24 or whatever, but we can see by cutting out sort of the post-COVID scenario, a better baseline normalized PE ratio for Disney, in my opinion, just based on data from 2011, taking out the craziness from COVID, is a normalized PE ratio of 18 with earnings growth at 10% per year. So if earnings growth is expected to be 11% per year, to me, it's fair to think about a baseline of a 18 PE for Disney. So how do I use that looking forward? What we could do is remember that the PE of 18 or 19, right? And then go to forecasting. And so what we can do here is we could put in analyst estimates for earnings. And so we've got, like we said, we've got estimates for the next 3 years. And the cool thing is you can see how many analysts have their expectations in, knowing that expectations are always wrong. So want to put that caveat in there. All right. But anyways, we've got it out here, and then it kind of just defaults because they don't have expectations in for 25 to 27. So what I do is I take it, and if they're at 16%, I want to be, more conservative, and I can put in 10% for those remaining years. And so this is just forecasting 16% at the end of 24 earnings growth down to 10%, 10%, and 10% for 25, 26, and 27, right? And remember, we had that PE of 18. So let's do a few scenarios here. If we go out to 2024, which is where they have analyst expectations in for, and we bring the PE to 19, or I'm sorry, that's 21. If we bring it down to 19.5, which is sort of in line with its average over the past, since 2011, you're looking at a 10% total return or a 4.8% annualized return. If we think that it's going to trade at a higher PE, which it does right now, it's at a PE of 30. So if we think that over the next few years, something like a PE of 23 is more appropriate, which I'm not saying it is, but just sharing this, then the total annualized return, if it is at a PE of 23 and hits these expectations through 2024, is a 13% annualized return and a 30% total return, which is pretty good if you think about the S&P 500 usually returns 8 to 10% per year, right? So maybe we call that the bull case through 24 is a PE of around 23, 13% annualized potential return. Base case could be a PE of 19 with total annualized return of 4.8%. Not as interesting there, though, given the security of Disney and its long-term performance, if you want to have money invested, maybe that's a decent option. But then sort of bear case scenario is maybe trading down to a PE of say 16, which is a 10%, 9% loss from here, or even down to a PE of 14 would be an 18% loss. So, depending on how somebody's looking at Disney, if they're looking for like a conservative type investment, proven track record, potential upside, probably going to reintroduce a dividend at some point, I would guess, or share buybacks at least, some type of return to shareholders there, then Disney could be interesting, right? It's obviously a winner, right? I mean, so if we're looking at the past 18 years, Disney has compounded at 12% per year versus the S&P 500 at 7.8%. That would have turned a $10,000 initial investment. It would have grown $76,000. Then you would have received $7,500 in dividends for total growth and dividends of $83,000. So $10,000 to $93,000 over 18 years. Not bad. Compared to $10,000 to $54,000 in the S&P 500. If you enjoy these, I can do more when it's quiet in the house in the mornings. Appreciate you if you follow me on. My dog just knocked the light out. I write a newsletter, austin.substack.com if you want to check that out. Focus on growth stocks. Thanks for being here. I appreciate you and hope you have a great day.